So an ESOP, ESOP, we live in a world of acronyms, but ESOP, Employee Stock Ownership Plan, what is that? So it's a qualified benefit plan. I like to compare it to the 401k plan. So an ERISA approved qualified benefit plan that is maybe a cousin to the 401k, but has probably three key differences. One being that it is allowed to borrow money, and the other is that it can have transactions with parties in interest. And then the third main difference is that the primary asset that it holds is going to be the stock of the plan sponsor.
Yeah, and I think one thing that's a question we get a lot about what is an ESOP and how it works is, do the employees actually own the stock? And
Right.
They don't own the stock, but they have these investment accounts that basically track with the value of the company and the share price.
And I think also I think some people are confused about ESOP and then ESOT. So you have the two acronyms, and the ESOT is the Employee Stock Ownership Trust, which is the actual entity that would own the company stock. And then the ESOP is the plan, right? So it's the qualified retirement plan within which the trust is participating, and all the employees end up participating. And so you have the separation of the trust from the company, and then the overall plan within which the ESOT is and employees are participating. And I think it's useful for the company owners when they're considering it to fully understand, because I think a lot of company owners think that it's the company that is the participant in the plan, which in a sense it is, because it's a sponsoring with the ESOT and the employees, but having the owner understand the difference between the ESOT, the plan, and the company, and the three different entities, or the two different entities and then the plan itself, helps them clarify, right, what the overall structure is.
That's a great point, because a lot of times, the operating entity itself it's not going to be an ESOP, but it's going to be owned by an ESOP. And that's a key distinction to make when we talk about what is an ESOP. Well, an ESOP is the entity that owns the operating entity.
Yeah. And then it really helps to understand the parties, because then it helps the owner understand that the company will make contributions, retirement plan contributions, to the retirement plan, which is the ESOP, and so just like any other qualified retirement plan that the company might set up, the crux of what's going on is the company's making contributions to the ESOP, and then the ESOP is initially using that to buy the company, to make the payments on buying the company stock, and then allocating the ownership of the company to the participants across the course of time.
So an ESOP works a lot like a 401k plan in that, again, it's a qualified retirement plan, and the employer sponsor is going to make contributions to the plan annually to service debt, if there's debt in the trust, to acquire the employer shares. And those benefits that go into the trust are going to be allocated to the participants based on their compensation, the total comp, very similar to a 401k plan.
And a lot of times, depending on how the original ESOP's acquisition of the company shares was structured, you'll have what we refer to as an inside loan, what we call an inside loan. And what essentially ends up happening is, as a company makes contributions to the ESOP can then use those funds to repay its inside loan, and those contributions can essentially be a cash neutral transaction to the company, because the cash will go into the ESOP and then it can come right back being used to repay that inside loan.
which is the spirit of an ESOP. It's to transition ownership from a company founder that's built a great culture and has maybe explored other options, private equity, strategic buyers, and wants to keep their culture intact and pass along the business to their family and their employees. So it's a wonderful way to provide benefit to the selling shareholders and to the employees.
And I think it's important to point out that ESOPs are when they were created, that they had, and they still do, bipartisan support. And, Congress put ESOPs in place to encourage owners to transition ownership, keeping in mind that the employees don't own the shares, but in essence, the value of the company is being transferred to the employees. And that's why these benefits were put in place.
So ESOPs are specifically one of the rare exceptions that you can have a qualified retirement plan receiving operating income from a business and not having to pay unrelated business income tax on that operating income. So an ESOP that owns an S corporation doesn't pay tax on the flow-through income coming from the S corporation. That's not generally going to be the case with any other kind of qualified retirement plan. So there's tremendous tax efficiency in that case, because the dollars that were otherwise being used to pay tax can be used to service the purchase debt on the ESOPs buying the stock from the company's founders or the selling shareholders. Right. And similarly, it's rare that a C corporation can deduct a dividend that it pays. But same thing, that the incentive was put in place, allowing an ESOP-owned C corp to deduct the dividend that the C corp pays to the ESOP when the ESOP uses that debt for certain required purposes, including paying down the purchase note.
And when you look at the tax incentives, tax benefits that are available for ESOPs that are out there, they're there to allow the company to basically use that tax benefit to service the debt on the purchase of those shares. So it's something to just point out and keep in mind as we look at all of the tax benefits that are there. Hey, what are they there for? Well, they're there to allow a company to service its debt.
Right. So you could look at it this way, that the IRS or Uncle Sam is part of the buyer of those shares. So they help fund that through those tax incentives.
All things being equal, if you have two potential buyers paying the same price for a company, and one is just a regular taxable entity doing the buying, and the other potential buyer is an ESOP, the ESOP has an advantage, because if it's buying an S corp or owns the S corp, all that money that would have been going to tax isn't going to go to tax, versus the taxable buyer, they're going to have the tax obligation. And similarly, if they buy the C corp, the ESOP will have that money that otherwise would have gone to tax relating to the dividend that's being paid. So all that avoids tax. It makes it easier to finance the purchase than it would be outside of the ESOP realm. The company needs to be able to make recurring annual contributions for the ESOP to be able to service the debt. And so a company, if it runs on, has some years where cash flow is really tight, it's probably not going to be a great candidate. So that's one. A company that doesn't have enough employees to have the critical mass, and there's some requirements.
You're right. That is very important. You don't want to have too few employees. And then EBITDA, so earnings before interest, taxes, depreciation, amortization. There's kind of a floor there as well. The cost of putting an ESOP is one of the common mistakes. People don't understand the complexity of an ESOP, and therefore the number of attorneys involved and other advisors that do come with a cost to put that in place. So average transaction, I would say, you're looking in the $400,000 to $500,000 range of fees. So you want to have a base of EBITDA that will cover that.
And I think a common mistake that some companies make when they're looking at ESOPs is not looking at employee census data and doing a repurchase obligation projection. So this repurchase obligation is basically a commitment that the company has to repurchase shares or the value of those shares as employees retire. And if you're not modeling that out, depending on your employee census data, that repurchase obligation can sneak up on a company. So it's important to go into it looking at your census data and looking ahead, try to model out what that repurchase obligation could be. And I think a common mistake is not getting an ESOP consultant involved early on to do a feasibility study. I mean, I think that's where you want to start when you're evaluating an ESOP. Go out, hire an ESOP consultant to do that feasibility study.
Yeah, definitely agree. Yeah, feasibility is a really good, first step if you want to take the ESOP a little bit further, in exploring that. So then I would say also surrounding yourself with the right advisors, whether it's a CPA, legal counsel, an ESOP specialist, someone who knows the trustees and the other parties that would be involved, administrators. So, trying to bootstrap an ESOP is probably a pretty bad mistake.